On the 16th of August, 1971, the Nikkei fell 7.68% in a single day. At the time, it was the largest one-day drop in the index's history, bigger than the Stalin shock. Nothing had happened in Japan. No Japanese company had missed earnings. No Japanese bank had failed. What happened was that the President of the United States went on television and ended the convertibility of the dollar into gold, and Tokyo found out at the same time as everyone else. 4 days later, the index was down 550 yen. Within 2 years, the yen went from 360 to the dollar to 240. That is the pattern this video is about. Not a company, not a sector, a variable that has moved Japanese assets for 70 years and that almost nobody prices, the design of the alliance itself. Here is the shape of it. The United States has spent decades telling Japan to do more of its own defending. Spend more, build more, carry more of the weight. Right now, that demand is louder than it has ever been. The Undersecretary of Defense for Policy has publicly said Japan should reach 3% of GDP as soon as possible, and the 2026 United States National Defense Strategy sets a standard for allies of 5%. And yet, in March 1990, a lieutenant general of the United States Marine Corps stationed in Japan was asked why American forces should stay. He did not say, to defend Japan. He said, no one wants to see a rearmed, resurgent Japan. And to prevent that from happening, you can say that we are a cap in the bottle. So the same country that keeps telling Japan to arm has, on the record, described its own military presence as the thing preventing Japan from arming. That is not hypocrisy, and it is not a conspiracy. It is a design decision, made deliberately, for reasons that are easy to understand once you see them. And this video is about what happens to Japanese assets when that design starts to move. Because it has moved before, 3 times. And each time the thing that moved was not defense stocks. It was the whole market. Welcome to Tokyo Tickers, where the ally telling you to arm is the one holding the lid. Start with the general, because the quote is more specific than people remember. The year is 1990. The Cold War is ending. Washington is openly discussing a peace dividend, bringing troops home, closing overseas bases. The Washington Post publishes an interview under the headline, Marine General, U.S. troops must stay in Japan. His argument is not that Japan is weak. It is the opposite. He says that if American forces left, Tokyo would further build up what he calls already a very, very potent military. The reason to stay is not that Japan cannot defend itself. The reason to stay is that it can. And note who is saying it. This is not a critic of American policy. This is not a foreign academic inferring motives from outside. This is a serving American general on the record, describing the purpose of his own deployment. If you want confirmation that this is taken seriously rather than treated as a gaffe, Japan's own National Institute for Defense Studies, a government research body, quotes him directly, word for word, in a paper published in 2024. Now, why would anyone want to restrain an ally? The logic is uncomfortable, but it is not complicated, and it has 3 steps. Step 1. Capability. Japan has one of the largest economies on Earth. It has the industrial base, the precision engineering, the materials science, the shipyards, and the capital to build almost anything it decides to build. Nobody in this argument thinks Japan is incapable. That is the premise, not the question. Step 2. Necessity. What Japan has not had since 1945 is not the ability, it is the need. A security guarantee removes the need. If someone else is holding the umbrella, you never have to buy one. And more importantly, you never have to have the argument at home about whether to buy one. Step 3. And this is the part that makes it a regional question, rather than a bilateral one. What happens if you remove the guarantee? Without an American nuclear umbrella, a country in Japan's position, facing the neighbors Japan faces, would have to at least consider its own deterrent. And the moment it seriously considers it, every country around it recalculates and starts building in response. That is the security dilemma. Once it starts, it does not stop at one country, and nobody has ever found a reliable way to reverse it. So the cap was never only about Japan. It was about not starting a chain reaction. And if that structure sounds familiar, it should. When NATO's first Secretary General, Lord Ismay, was asked in the 1950s what the alliance was for, he gave an answer people still quote: "To keep the Russians out, the Americans in, and the Germans down. 3 jobs, and only one of them concerns the enemy. Read the Japan-US alliance the same way and you get: keep China out, keep America in, keep Japan down." Not as an insult, as a specification. And here we should be careful, because it would be easy and wrong to hear this as a story about victimhood. It is not. A country that outsources its security buys something real with that decision. Japan bought 80 years in which capital went into factories instead of fleets, into Toyota and Sony instead of carriers. Whatever else this arrangement was, it was also the condition under which post-war Japan got rich. Both things are true at the same time, and any honest version of this story has to hold both. Which brings us to the useful part. If the alliance is a variable, we should be able to look at what happened the last few times it moved. It has moved 3 times in a way that is easy to date. And in all 3 cases, the lesson for investors is the same, and it is not the one you would guess. Case 1, 1971. The Nixon shock. Washington suspended the dollar's convertibility into gold, imposed a 10% import surcharge, and did not tell Tokyo in advance. Japan learned about it from the broadcast. The Nikkei fell 7.68% in one session, a record at the time, and 550 yen over 4 days. The Bretton Woods peg of 360 yen to the dollar collapsed, and within 2 years, the currency was at 240. Note what did not happen. No Japanese company had done anything. The entire move was a repricing of Japan's position inside someone else's decision. Case 2, 1985, the Plaza Accord. This one was not a surprise. It was an agreement, signed at a hotel in New York by 5 finance ministers. But the substance was that Japan agreed to let its currency appreciate, because Washington needed it to. The yen went from around 242 to the dollar to 153 within about a year, and to 120 by 1988, a rise of close to 50%. Japanese growth fell from 4.4% to 2.9%, and then comes the part that matters. To offset the damage from a stronger currency, the Bank of Japan cut the discount rate from 5% to 2.5%. It halved it. Cheap money for years. That money did not go into exports, because exports were the problem. It went into land and equities. The Nikkei ended 1989 at 38,915, 3.1 times where it stood when the accord was signed. Urban land prices peaked about 4 times higher. And then all of it came down, and Japan spent the next 30 years dealing with the consequences. The alliance did not cause the bubble on its own, but the trigger for the policy that inflated it was an agreement Japan made because its security partner needed it. Case 3, 1991, the Gulf War. Japan contributed $13 billion, 1.5 trillion yen, the largest financial contribution of any ally. It sent no troops because its constitution did not permit it. And when Kuwait took out a full-page advertisement in the Washington Post thanking the coalition, Japan was not on the list. At home, it was called checkbook diplomacy. The financial cost was real, and the return was 0. That episode is a large part of why Japan spent the following 3 decades slowly, carefully expanding what its self-defense forces are permitted to do. 3 cases, 1 pattern. In every one of them, Japan was not the actor. It was the recipient of a decision. And in every one of them, the asset that moved first and moved most was not a defense contractor. In 71, it was the currency and the index. In 85, it was the currency, then rates, then every asset in the country. In 91, it was the fiscal account, and eventually the interpretation of the Constitution. If you were watching the defense sector for the signal, you were watching the wrong screen. So what is different now? 3 things moved at once, and only one of them happened in Japan. The first is that Japan met the number. According to the Ministry of Defense's own budget documents, Japan brought forward the 2% of GDP goal and achieved it in fiscal 2025, using a combination of initial and supplementary budgets. The build-up program running from 2023 to 2027 totals 43 trillion yen. For fiscal 2026, the expenditure budget for that program is 8.8 trillion yen, and the broader figure, including complementary initiatives, is around 11 trillion. Japan is no longer the ally that will not pay. It paid. The second is that Japan changed what it is allowed to sell. On the 21st of April, the 3 principles on transfer of defense equipment were revised. The 5 non-combat categories, rescue, transport, warning, surveillance, minesweeping, were abolished. Equipment is now sorted into weapons and non-weapons, and weapons can be exported. Be precise about the scope, because this gets exaggerated. Lethal exports are limited to 17 treaty partners, essentially the Western Alliance. This is not Japan entering the open arms market. It is Japan being permitted to sell inside its own alliance. But the restriction it removed did not come from trade policy. It came from the post-war settlement, from the same soil as Article 9. The third is the one nobody planned, and it is the reason this is being recorded now. Since late February, the United States has been at war with Iran. As of early August, that conflict is in its 6th month. The Strait of Hormuz has been effectively closed to Western-linked commercial shipping since the 4th of May. On the 1st of August, President Trump called off a multi-day air campaign, described as the largest strike operation since the Second World War, citing progress in talks. Those talks are live as this is recorded, with Oman mediating. Nothing is settled. Now, hold those 3 next to each other. Japan has paid. Japan has removed its own export restriction, and America's attention, munitions inventory, and carrier availability are being consumed 6,000 miles away, which raises the question this whole episode is circling, and that nobody can answer honestly. If the same thing happened in East Asia, how much hand is left to hold the lid? We are not going to tell you whether that will happen. Nobody knows. But notice that the uncertainty itself is now a variable, and unlike a war, uncertainty gets priced immediately. So where does it show up? Not a forecast. The 3 historical cases tell us which channels actually carried the move, and those channels have not changed. There are 4. Channel 1, the currency. In 71 and again in 85, the yen moved first and everything else followed. That is not a coincidence. The exchange rate is the fastest instrument for repricing a country's external position, and Japan's external position is defined by the alliance. If you want an early signal that the design is shifting, you do not watch defense stocks. You watch the yen. Channel 2, energy. And here the numbers are stark. In fiscal 2024, Japan's dependence on the Middle East for crude oil reached 95.9%, the highest since the mid-60s. The United Arab Emirates and Saudi Arabia alone account for the bulk of it. Roughly 93% of Japan's oil imports transit the Strait of Hormuz. Of the major economies assessed for exposure to a Hormuz disruption, Japan scores the highest risk. This is the channel where an American war in the Middle East reaches a Japanese balance sheet directly, not through defense contracts, but through the input cost of every manufacturer in the country. Worth adding that liquefied natural gas is a different story. The Middle East share has fallen to around 11%, from 29% in 2013. Japan diversified gas. It did not diversify oil. Channel 3, fiscal. Japan has met 2%. Washington is asking for 3%, and its own strategy document sets a 5% standard for allies. Do the arithmetic for scale, not as a prediction. Using the government's own denominator, 1 percentage point of GDP is on the order of 5 to 6 trillion yen a year. Moving from where Japan is now to 3% is roughly that. Moving to 5 is several times it. A country with Japan's debt position does not absorb a permanent annual increase of that size without something else adjusting, taxes, other spending, or the bond market. That is not a defense story. That is a rate story. Channel 4, and the one most people skip, sector composition. If Japan is allowed to sell weapons into 17 countries, the companies that benefit are not only the obvious names, they are shipbuilders, materials firms, precision component makers, and the trading houses that already run defense-adjacent supply chains. And on the other side, a country that must reroute 93% of its oil is a country where shipping, refining, and utilities reprice. Between April 2025 and April 2026, Japanese imports from Gulf suppliers fell 64%. Someone carried that cargo a different way, and someone paid for it. And here is the genuine counter-argument, which deserves to be stated properly rather than dismissed, and it comes from inside the Japanese defense establishment itself. In the same 2024 paper that quotes the general, a researcher at Japan's National Institute for Defense Studies documents that many scholars now argue the cap-in-the-bottle model has already collapsed, overtaken by China's rise after the Cold War, overtaken by the steady expansion of what Japan's self-defense forces actually do, overtaken by an alliance that has been deepening rather than restraining. On that reading, the lid stopped being a lid some time ago, and 2026 is not a jailbreak. It is a partner doing more inside an arrangement that was quietly renegotiated years ago. There is more supporting that view than people assume. Article 9 is still in the Constitution. The April protests were not small. Lethal exports are capped at 17 treaty partners. The alliance, not the open market. An American pressure for higher spending is a sign of engagement, not withdrawal. You do not ask a country to spend 3% of its economy if you are planning to leave. So where does it get decided? In December, Japan publishes a revised national security strategy, a revised defense strategy, and a new defense industrial strategy, and the Ministry of Defense has already confirmed that review is underway. Read what those documents say about export scope and about targets. That is the closest thing to a scheduled answer that exists. Until then, here is the thing worth carrying out of this. In 1971, the Nikkei fell almost 8% in a day because of a decision made in Washington that Tokyo was not told about. Nothing in Japan had changed. Everything about Japan's position had. None of this is investment advice. It is a way to see that some of the largest moves in Japanese assets have never been about Japanese companies at all. They have been about what Japan is permitted to be. If that is the kind of thing you like to understand, this is the channel for it. Follow Tokyo tickers, Japan, explained for global investors. Every umbrella you are handed is also a decision someone made for you.